everybody, and welcome to today's session. I'm Caoilfhionn van Walt. I'm the managing partner of Regan van Rooy, and we are very happy to have Tracy Potgieter doing our first webinar as part of the Regan van Rooy team. So Tracy is our South African corporate tax partner based in Joburg, and this is your first webinar with us, Tracy, but definitely not your last. So welcome, and thanks for coming here today to explain all that's been happening over the last few months with the TLAB, as they call it. So before we dig into the detail, can you just give us some context of what is the TLAB? So remind us what the process is in terms of the budget and Annexure C, and then the draft legislation and when it becomes legislation, and where are we in the process? Of course, bearing in mind that it's already been a complex year with all of the different budget speech iterations we had.
Sure, thanks, Caoilfhionn, and thanks for scheduling this webinar for this topic that I'm clearly passionate about. So just to give everyone a little bit of context of what it is we're talking about. The legislative cycle is quite a complicated process. So in the year prior to a budget speech, there are a lot of proposals from businesses, from individuals, from SARS themselves, where there are issues with the current law, where there are possibly loopholes in the law, where there's schemes that might arise, and a lot of proposals are made through to National Treasury of where changes should be made in the law. In a normal year, so this year has not been a normal year from a budget speech point of view at all, but in a normal year at the budget speech, the Minister of Finance will announce some of the proposed tax amendments, but also hidden in the detail is something called Annexure C, which gives all of the proposed amendments. And it is a very difficult process to change this Annexure C. So if it is on Annexure C, it will be dealt with in that legislative cycle. If something else comes up, it is generally deferred to another year. Annexure C and the proposals then turn into what we're now sitting with, which is the draft laws amendments. So we have revenue laws amendments, we have draft taxation laws amendments, and we have the draft Taxation Administration Law Amendment Bill. So it then gets sent out for comments, and all of the relevant interested parties will make comments. So you will have seen CICA, CIPA, various of the companies will have given comments on the changes, and then National Treasury are supposed to take these changes back. So we are in that process at the moment. The window period for comments has closed, but we are now sitting in the period where National Treasury consider the comments that have been made, and then they will then do what they call the final sort of legislation, that they then have another set of, not consultations, almost informing the role players where they sit with the various comments that they've received, and then that will get tabled in Parliament. And we generally see that happening, depending on how contentious the issues are, round about December of this year or early January. This will be tabled, and what is left in it, if they don't take any of the comments into account, will become law that we will need to apply going forward.
Great, thanks for that summary. And I think that gives some good context to the kind of winnowing process we're in now. And I'm sure everyone who's joined knows there was big kerfuffle over the 8E changes that were then scrapped. So I know we'll cover that later, but I think that shows how this process works, that there is a period for making comments. Those comments are sometimes listened to, and then we see changes. I'm going to share our slides now. And guys, we will send the recording of today and the slides afterwards, and our contact details are in those slides. Now, we do appreciate this is quite a technical topic we're covering, so please do feel free to raise any questions in the chat as we go, and we'll address them. So in terms of the agenda, this is what we're planning to cover today. So we're looking at the draft Taxation Laws Amendments Bill. First, we'll look at the impact for individuals. Then we'll look at the key changes for businesses and corporates. Then we'll look at what the changes are for trusts and collective investment schemes. Then we'll move on to indirect taxes, some big changes there on the VAT side. Then we'll look at changes to the tax administration and compliance procedures. Then we'll deal with various effective dates and transitional measures. And finally, we'll list what we think are the key issues that anyone impacted should be thinking about doing now. So that's what we're planning to cover. And as I say, if you have any questions as we go, you want to chip in or add something or ask for clarity, please write in the comments and we'll deal with them as we go. Otherwise, over to you, Tracy. I'll start here with the key changes for individuals.
Thanks, Caoilfhionn. So as Caoilfhionn has already alluded to, there are a huge amount of changes. There is no way we can cover every single possible suggested change in this session. So what we try to do is pull out some of the more interesting or more contentious changes that there might be. So the first sort of very contentious change impacting individuals is the proposal to remove the exemption for foreign pensions. Now, currently, the situation is that if you are a resident and you earn a foreign pension, either because you were previously non-resident or you worked outside the country for a period of time and you contributed to a foreign pension and you now are back in South Africa as a resident, any payments from those foreign pensions are currently not taxable if it relates to past employment outside South Africa. National Treasury believe that this has a double non-tax effect. And what do we mean by that is South Africa is taxable on what we call a residence basis of tax. So if you are a resident in this country, you should be paying tax. With this exemption, you won't pay tax on the foreign pension in South Africa, but the foreign country may also give an exemption to you for that foreign pension. So as much as everybody hates double tax, revenue authorities hate this concept of double non-tax just as much. So their proposal is that somewhere, and also generally a treaty will give South Africa the right to tax these pensions, and we've effectively waived the right with this exemption. So the proposal is to effectively delete this section, and in SARS's view, to what they refer to is uphold the residence basis of taxation. The next amendment impacting individuals that I found quite interesting is there's a section in the Act called Section 20A, which effectively was introduced many, many years ago. And it was introduced really to prevent individuals that want to use losses from certain hobby-like trades. So you would do these different trades, and SARS have labeled them suspect trades, and you would utilize losses that arise from those suspect trades to reduce your overall taxable income. So they put in a limitation saying if certain criteria are met, then this would not, you would not be able to use the losses from these trades. It's important to know this only applies to natural persons, does not apply to companies or trusts.
Tracy, can I ask about that? Sorry to interrupt.
Yes.
Is this targeting farming losses, do you think?
I don't believe so. I think I believe there is a specific carve out for farming, but I'd have to double check that.
Okay, so, I'm more thinking about my husband when you talk about hobby activities. Curious.
So up until now, you've kind of had a carve out because there've been a number of requirements for the section to apply. And one of the key requirements is that it only applied to taxpayers in the highest tax bracket. So, okay, I'll structure my affairs to either have deductions or whatever the case may be, and I'll fall into the one below the highest tax bracket. And magically, that waves the magic wand and the section does not apply. SARS are not happy with that, and their proposal is that they believe there are people that should be caught by this who fall slap bang into the rest of the provisions, but they are not being caught. So the
Okay.
proposal is to lower that threshold. What that threshold will be lowered to, we're not 100% sure. Any questions on that? Happy for me to proceed? The last one that is also quite an interesting one, and I hear myself saying interesting all the time, and I'm thinking it's only interesting to a tax nerd, but yes, it is interesting to me, is a change to the definition of remuneration proxy. Now, what is a remuneration proxy and what does it mean? Effectively, a remuneration proxy is a deemed amount that is defined in the Act, and it is used in certain cases. One of the instances where you use the remuneration proxy is where you have a person that works for a company that they own or control, and they are earning less than market-related remuneration. Then SARS can impute the remuneration proxy. It's also commonly used through the fringe benefits sections, where some of the values of the fringe benefits are referred to this remuneration proxy. All of that is fine, no problems. However, the remuneration proxy specifically excludes amounts that were exempt in the prior year. So the remuneration proxy refers to income that you earned in a prior year. Where an individual qualified for the foreign employment exemption, which I believe is at about 1.25 million rand, if you're working outside of the country for a certain period of time, and you qualified for this exemption in the prior year, in the next year, when SARS want to apply this remuneration proxy, you effectively have an artificially reduced remuneration because it would exclude these amounts that were exempt in the prior year. So really, the proposal is to try and get an even playing field between taxpayers that did qualify for this foreign employment exemption and taxpayers that didn't apply for it, is to put them on an equal footing, and they effectively want to include these previously exempt items in the definition of a remuneration proxy. So
that's very interesting. So all three of these, Tracy, it seems to me, are quite sophisticated tinkering of provisions to target what SARS saw as kind of loopholes for people to reduce their personal tax.
Yes, and I think the noose around individuals is just getting tighter and tighter.
Yeah.
I mean, years ago, there were so many things that individuals could do. And I even had a meeting yesterday with clients that asked, what can we do to reduce our taxes? And there's pretty much nothing left to do. And the noose is getting even tighter. So yes, you're 100% correct there, Keelan.
Great, thanks for that. So some quite big changes, and in particular for people who are earning foreign income or foreign pension, lots of things they'll need to consider.
Absolutely. Right, on the business front, so there was a massively contentious proposal that was very sort of quickly withdrawn by National Treasury, but it kind of is, in my mind, eclipses everything else that has been put out there. And that was, they wanted to tax preference share according to the IFRS debt classification. And that, even though it has been withdrawn, I don't think anybody can rest. I think, watch this space. Having been involved in tax for as long as I have, if they've put something like this out and they've withdrawn it as quickly as they have, it is not something that they have said, oh, well, we're going to just forget about it. It is something, if you want Tracy's prediction for next year's Annex C, this is going to be on it. They've now just gone back to the drawing board to see how better they can implement it, because it had an unintended consequence of hitting BEE schemes, but it is still something that is used in a lot of instances, probably not 100% above board, and they are aware of that.
I totally agree with you, Tracy. So when the TLAB came out initially, all everyone was talking about was the 80 changes. And I agree, it sort of eclipsed other very important ones that we're going to cover. And also then when it was scrapped, there was a sort of collective sigh of relief. But I totally agree with you. Don't assume that we're not going to see this again. Likely SARS and National Treasury are going to tidy it up, and we'll see it back again. So if you're looking at these type of instruments, so hybrid equity instruments, it's worthwhile being quite wary.
I mean, I certainly, just on that point, if I have a preference share in my structure, or I'm planning to structure using preference shares, I would certainly be thinking twice or getting absolute expert advice on that. So I wouldn't enter into a new structure with preference shares lightly.
Absolutely.
But yeah, going on, and just 8EA kind of carries on in the same sort of vein. So there's an absolute obsession, and we'll see it with 23M and those changes as well. There's an absolute obsession in Treasury and SARS that all taxpayers are crooks. And at the risk of digressing a little bit from what's on the slide, I recently spoke at the SATE seminar on Pay Now. Pay now, ask
later.
Yes, that's it. And again, it's all about putting in legislation to catch the few, who have the money to put in these fancy structures and who may be skirting on the fringes of the law. Whereas you've got, on the 80/20 principle, most taxpayers actually are honest and want to pay their taxes. But nevertheless, we keep seeing amendments, in my opinion, that are dealing with the exception, not the rule. And the amendments to 8EA are along those lines. So for the benefit of anyone that doesn't know what 8EA is, it is again, an anti-avoidance type of section that deals what is called a third-party backed share. And it's very complicated wording, and I'm going to try to just break it down slowly. So a third-party backed share is a share that encompasses either a preference share or an equity instrument where the value of that share is determined referenced to a preference share. And it has an enforcement right. So the key here is to focus on enforcement rights that the holder of the preference share can enforce. So now, if we can just pause for a moment, the holder of the preference share is the person that is going to receive the dividends. If you fall foul of this section and you receive a dividend, it is deemed to be income, not interest, income, which means you'll be taxable on it. So if you are a holder that has an enforcement right, which I'll go into now, and at the time a dividend is paid, currently the law says that that is not a dividend, it will be income. So an enforcement right is really the right that this holder, the person who has the preference share, has to compel certain performance obligations by third parties, hence the reference to third-party backed share. And it really arises from being able to enforce performance by third parties to acquire the shares from the holders. So just before the dividend is paid, you say to somebody, right, you have to acquire this, or you can enforce the right for somebody to make payments under that instrument. If any of this is the case, then, as I mentioned, those dividends or foreign dividends are deemed to be income. So what has happened is SARS and Treasury have become aware of a scheme in the market where, even though there is this enforcement right, the enforcement right could contractually only be exercised at a certain point in time. And just before that, the dividends would be payable, the holder would contractually waive the enforcement rights. So now what they have is no longer an instrument falling into the section. So the proposal is really, after a lot of words, is that they want to bring in a provision that you don't look at the time when this enforcement right arises, but effectively you look at the terms of the arrangement, and kind of once in and there's an enforcement provision there, you fall foul of the provisions.
Well done, Tracy. That's a very complicated rule to explain. You did a good job of simplifying it. And it seems, again, that that's one of those instances that is going to have a very broad change, and it's targeted at a very small group of people who've been misusing the intention of that provision.
Yes. So a complicated section with a minor amendment is section 24I. So section
24I is one of those really complicated provisions.
Yes. So to make it not very complicated, essentially, if you have realized or unrealized foreign exchange differences on debt instruments, they are taxable or deductible. That's a very, very high level. There are obviously exceptions to exceptions. But the proposal is to include preference shares now as one of these debt instruments on which you would determine an unrealized or gain or loss. The commentary that I've read is that this was brought in kind of in hand with the Section 8E provisions on hybrid debt instruments, and the two were meant to go sort of hand in hand. We've seen the removal of the 8E proposals, but we've not seen the removal of this 24I, which I think could just be an oversight. My sort of prediction is that this will be removed when we see the final provisions.
Yeah, that would make sense. And it seems like the focus was on 8E and getting that change kicked out. And this is the sort of ancillary change that was proposed. Okay, great.
Okay, so now we look at collective, in mind blank, collective investment schemes and some of the corporate rules. So again, not going to try and unpack what corporate rules are. Suffice to say, there are provisions in the tax law dealing with corporate reorganization type transactions, liquidations, unbundlings, asset for share, amalgamations, but there's a specific section allowing you to effectively reorganize your group. So because of the unique way collective investment schemes are taxed, so a collective investment scheme is legally structured as a company, but it is taxed like a trust. There's furthermore an exemption to a collective investment scheme that they are exempt from capital gains in the collective investment scheme, and only when the ultimate investor that holds a unit in a collective investment scheme sells their investment is capital gains triggered. So against that backdrop, there is, again, an avoidance. And when I say avoidance, there must have been real transactions that SARS have been made aware of where people have done this. They wouldn't have dreamt these kind of things up. But what they have seen is that there's an abuse of specifically Section 42, which is your asset for share provisions, and Section 44, which is your amalgamations and collective investment schemes. And I'm going to give an example of what this avoidance is. So in a asset for share or share for share, you will have two parties. So if I have shares that have appreciated in value, but I want to get units or shares in a collective investment scheme, I can enter into an asset for share exchange where I will transfer my assets to the collective investment scheme, and I will get units or shares in the collective investment scheme in exchange. That must be done at value. So I'm getting value for value. But because of the corporate rollover transactions, I don't pay any capital gains tax on that transfer. The idea is, if this were not a collective investment scheme, the idea is that the company that is taking on my assets and issuing shares to me takes those on at base cost. If they were to sell those shares, they would then pay the capital gains tax. Because of the weird way that collective investment schemes work, what happens in sort of very basic terms is that I will transfer my shares that have appreciated in value to a collective investment scheme under a Section 42. I don't pay any tax at the time that I do this, and I get collective investment scheme shares for the same value. Because the collective investment scheme is exempt from CGT on the sale of the shares, the collective investment scheme can sell those assets immediately and there's no CGT. The CGT is completely lost. Unlike all other scenarios where if the company sold the shares immediately, it would trigger CGT. So effectively, there's a loophole of that original gain that is realized in the market, but no tax is payable at that point of realization. So really the proposal is to withdraw specifically the Section 42 and 44 relief on transfers made to corporate investment schemes.
Okay, and that sounds like another quite sophisticated tinkering to shut down unintended loopholes.
Caoilfhionn, I think you're 100% correct. We've seen a lot of sophisticated tinkering. So it's going to be interesting to unwind and consider these kind of nuances going forward. But hopefully we're getting into some of the easier ones now. So just a very, not a basic, but so everyone, well, I'm hoping everybody is aware that from 2023, the balance of a carried forward assessed loss was limited to essentially 80% of your current year taxable income. Then there was a question in the market posed, what do we do with Section 18A donations tax deductions? Because as you may be aware, the donations tax deduction references to taxable income before claiming this deduction. So now do you do your assessed loss? Do you do your 18A? Which one comes first? And they really are just clarifying that you will first apply your 18A and then you apply the assessed loss limitation. And
Makes sense.
Then very lastly, and I don't want to get into a lot of detail on this because 23M is a very complicated section that is, we've also seen a lot of changes over the years, but at a very high level, Section 23M was introduced to target, again, interest deductions, this obsession from SARS that somebody might be claiming a deduction on the one hand and the other party is not taxable. So it targets interest deductions where there is a direct or indirect controlling relationship between a debtor and a creditor, and the interest is deductible on the one hand and not taxable in the hands of the recipient. As I mentioned, this definition and section has grown legs over the years, and the wider definition of interest for 23M purposes also brings in foreign denominated amounts, irrespective of whether interest has been charged, and effectively turns your foreign currency difference into interest. So now you will have a situation where you have an interest limitation on your foreign exchange loss, but the other side of it is not taxing the foreign exchange gain because they don't have the same kind of taxing system as us. So really what they've done is they've said, okay, we have heard you. We see that this section is complicated, and there are a number of changes to clarify and simplify the meaning of interest back to, I guess, what the core was, which is to hit interest and not these foreign currency amounts.
Okay, very interesting. So guys, we hope you're still with us. This is probably the most dense and complex slide in terms of the changes we're going through. A reminder, if you have any questions or any comments on what we're covering, please put it into the chat. And now we'll go on to changes for trusts and CIS.
So this is the easy slide. This is where I get to catch up some time, perhaps. So again, there are lots of changes, and we've only picked on those which we thought would be relevant or interesting to the audience. So with trusts, everybody is aware that trusts are taxed on there are attribution rules for trusts, and it's really just a clarification, not an amendment, that the flow-through principles and the attribution rules only apply to income received or accrued to resident beneficiaries and resident owners. Donors, not owners. With regard to CISs, so currently, if a collective investment scheme distributes interest or dividends, it's taxable in your hands as the investor. There's a flow-through approach that applies to collective investment schemes. Where a collective investment scheme makes a distribution of capital, which is not often, but it could arise, there has been some sort of confusion and discussion about what to do with this capital distribution. And one of the discussions that Treasury, or suggestions that Treasury made last year, is that perhaps if you get a distribution of capital, you should reduce the base cost of your investment in the CIS. And after much consultation, they concluded that this would be extremely difficult to keep track of. It would put a lot of a burden on the CISs to keep track of the amounts people invest and the reduction in those investments from a distribution of capital. And they've gone with a much simpler approach, which is if you receive a capital distribution, it will be taxed as a capital gain immediately. Yes, this may mean that there are earlier tax liabilities, but it is a much simpler and much less complicated regime. And the commentary that I've read on this is that it is not often done. So it shouldn't really have too much of a negative impact on investors, or at least we hope.
Great. And now indirect taxes. I know there's been some interesting changes here.
So yes, I'm actually going to just sort of go out of order to discuss kind of the easy ones first, and then I'm going to focus on the schools. So the first VAT amendment is currently VAT on low value imports. There's a monetary threshold, I believe it's 500 Rand, which means that certain imports below that monetary threshold are not VATable. And the proposal is to remove that completely, making all imports subject to VAT. So this could have a big impact on systems. It could have a big impact on e-commerce, smaller importers. So it's not that easy, and it could cost people a lot of money, and not so much in the actual VAT payable, but just changes to systems. I think SARS underestimate and underappreciate what these changes mean to businesses. Then I just want to hop to the VAT treatments of airtime vouchers. And it's not something that I've really dealt with, but effectively there seemed to be some uncertainty about airtime or data sold by foreign telecom providers for use outside South Africa. And there seem to be some foreign telecom providers that were being forced to register for VAT and pay VAT on this, but it doesn't make sense. You're a foreign provider and it's for use outside South Africa. So it really is just an amendment to say that to the extent that the airtime is consumed offshore, you're not into the VAT net. So SARS no longer need to monitor foreign telecom companies, and it will only focus on local distributors. So VAT will only be charged on the distribution services by South African resellers who sell these vouchers to local customers. Then probably the biggest VAT shock of them all is the forced deregistration of schools from the VAT net. This is expected to especially impact on private schools. So in the explanatory memorandum, National Treasury state, and they go all the way back to 2013, and they say that they've been saying for years that it has always been their intention for schools or educational services to be VAT exempt. So from their perspective, all they're doing is now making the law clear as to what their intent always was. The way they are implementing it is they are saying that all school-related goods and services are to be regarded as VAT exempt, and this includes previously commercial activities that were related to the school, like facility rentals, tuck shop activities. Look, at my school that I went to, I don't think the tuck shop ever hit R1 million, but I guess it's some of the private schools and the more prestigious schools and schools that have a sort of from grade 0 all the way through to matric, you could have hit R1 million with just your tuck shop activities and not voluntarily registered for in terms of the VAT Act. What does it mean, though, to have a forced deregistration? A forced deregistration triggers a deemed supply. What does this mean? It means that on the 31st of December 2025, because this amendment is set to come in on the 1st of January 2026, you are deemed to have sold all your assets as a school, including your buildings, including equipment, all at market value. And it's not limited to assets that you claimed input VAT on.
Wow.
So it doesn't. Yes, and I didn't realize that. I had to read twice when I realized that. So even in the instance where you may have been exempting, or you would have been exempting your school fees charged to kids and maybe only claiming VAT on your tuck shop related activities and had a apportionment, you might have only been claiming 5 or 10% of your VAT. This is now going to trigger a VAT liability on everything. So,
wow. Because
it's
when
big.
when I saw this change, I actually thought it was good news for schools. In comparison to the big VAT changes on private school fees in the UK. So I thought, oh, this is good news for South African schools, but I didn't understand that deregistration impact. That is going to be a very big deal now at the end of the year.
But not so much of a big deal, because SARS are going to give you 12 months to pay your tax. So it's okay.
Very kind of them.
Very, very kind.
Great. So we've gone through the impact of the changes for individuals, companies, trusts, CIS, indirect tax. Now, can you please talk us through the main changes from the tax administration and tax compliance perspectives?
Okay, so there wasn't much meat, except for the last one, which I want to spend a little bit of time on. So I'm going to scooch through the first few very quickly, and the one is Section 18A, donation deductions. Previously, the provisions of the law said you could only claim an 18A deduction for a donation that you've made if you are in a possession of an 18A certificate, and that 18A certificate must have been audited. So it specifically used the word an audit certificate. This caused a lot of confusion and a lot of discussion at SAICA, who govern essentially accountants and auditors, to say what the word audit has a lot of connotations. Yeah. So if you are just a small PBO, and you now, to enable you to issue an 18A certificate, have to go and get an audit, this will be punitive. SARS issued a guide saying they don't mean audit as in a statutory audit, they just mean somebody else must have applied their mind to it. Still caused confusion in the market, and really they're just bringing in a change of wording to say a certificate of examination by an independent person. Just makes it just clarifies for those smaller PBOs that you don't have to go and engage with a firm of auditors to get your certificate signed off.
That's good news then, and seems a helpful clarification.
It is.
Great.
The other interesting one is, for years we have had voluntary disclosure provisions and relief for for normal income taxes, VAT, employees tax, but there was nothing that mirrored that in the customs legislation. So now it's also, again, good news, but they are effectively uplifting the voluntary disclosure provisions and putting them in the customs legislation. So again, another bit of a good news tax administration issue.
So Tracy, does that mean we can now do a VDP for a customs issue?
Yes.
Oh, that is good news.
It is very good news, and it was previously carved out, so it is very, very good news. Well, I say it's good news in theory. My experience over the last sort of 18 months with voluntary disclosure is that we are facing a very aggressive SARS. They are looking for all sorts of reasons to decline voluntary disclosure. So while it theoretically is good news, how implementable it will be and what the appetite SARS will have remains to be seen.
To be seen, yeah.
Another not so good news amendment is that, although I say not good news, but it kind of somewhat makes sense to me as a conservative tax person, is that SARS are now introducing a provision where prior to registering you for either VAT or for income tax, they have the right to come and do a site visit where they can actually see that there are real premises and that your premises are set up for the business that you are applying for registration for. So that could be interesting because, yeah, what if I'm doing business from my house and I'm selling goods and I've just got them in my study? Is that not going to pass the test? I'm still paying my taxes on the income when I sell the goods. So that one I'd like to see that being applied also in reality, because I guess it also assumes that SARS have this infinite number of people just out there to come knocking on your door.
Yeah, interesting.
The other one, which is, so there's always been a provision in the law that you can apply for a suspension of debt. So again, earlier when I referred to the pay now, argue later principle, that is subject to a taxpayer being able to say, well, I can't afford to pay this. So while we're working this out, can I suspend the debt that I owe? That only applied for additional assessments. But in certain instances, you may not be disputing the full assessment. You may be requesting a reduced assessment, but there's still a balance due that you can't afford to pay until the whole sort of legal cycle has worked its way out. And they've now extended the ability to apply for a suspension of debt in the case of a request for a reduced assessment. So again, a little bit of good news for taxpayers.
Okay, yeah.
Then the last one that I want to spend a little bit of time on is this sneaky, and I call it sneaky little amendment that SARS have put in related to understatement penalties. So an understatement penalty can be imposed by SARS in certain instances, and it generally relates to whether there's been a substantial understatement, and that is defined in the taxation laws, or if there are certain behaviors, and then if there's a first instance of offense, etc. But preceding all of this was almost I guess, a get out of jail free card, which was if what you had done that SARS have now found and are wanting to tax you on and levy a penalty on, met the definition of a bona fide inadvertent error, no understatement penalty could be charged. And if we sort of unpack those words, a bona fide inadvertent error is literally an honest mistake without the intent to deceive. And that happens all the time. You leave a zero off, or you add a zero, whatever the case may be. SARS have come out and said, we're not changing the law. Again, one of those where all we are doing is we are clarifying what was always our intent, and they are moving the piece that refers to bona fide inadvertent error down into the section dealing with substantial understatement. So what does that mean? It effectively means that you will only be able to use this get out of jail free card where it's a substantial understatement. If SARS are wanting to levy an understatement penalty relating to any of the behaviors, you will not be able to use this, even if it was a bona fide inadvertent error.
Wow, that's interesting and potentially quite unfair because it reduces the scope where you can claim this exemption.
It really does. And again, there's been a lot of chitter chatter on LinkedIn, and a lot of people are doing presentations, and everybody is referring to SARS and Project Billions. And are we facing an overly aggressive SARS? I am seeing just on the behaviors where it would ordinarily meet the definition of reasonable care not taken. And SARS are looking at this and going, we don't agree that the behavior is reasonable care not taken. We are deeming it to be gross negligence.
Wow.
So they are pushing for the behaviors that give them the maximum amount of penalties. So without this sort of being able to argue legitimately, I made a mistake, it could really be pushing people into big fights with SARS.
Very interesting. So Tracy, thank you so much for taking us through the kind of choice pick of all of these changes. Lots of very interesting and some very nuanced changes that may well have large impacts. In our last few minutes, and audience, you still have an opportunity to ask questions if you would like, but can you take us through your key recommendations on what you think people should be doing now in dealing with these changes?
Yes. So I think specifically with individuals and global mobility and people moving around the world and digital nomads and all of those kind of things, is evaluate those strategies, evaluate your cross-border pension benefits. Maybe, if you are a foreigner thinking of coming to South Africa and you do have a foreign pension, maybe talk to your advisors about trying to structure and put that foreign pension into a structure that can protect those foreign payouts. So I think global mobility, we're going to see a lot, and people need to focus on moving around the globe and what that might mean to them. And then also, if you do have, and I want to say suspect trade, because not everybody is necessarily doing some of these trades that SARS deemed to be suspect trades, because you can fall into this as well if you're just making losses. So it could be just normal trading losses. Is just reevaluate where you sit on that, and can you justify to SARS that you have a real commercial activity. So the one thing, and this just goes across everything in tax, is document. Have your documentation in order. So then looking at corporates, just I think we've already said it, is any structure that involves preference shares, you need to look at that. You need to consider it. It almost eclipses anything else. And if you were looking at doing any form of reorganization involving a collective investment scheme, which is kind of a very niche thing, I don't think everybody's doing that every day, is just consider those proposed amendments. VAT plan for the VAT changes, as I mentioned when we discussed those amendments, is it's going to affect systems. Make sure your systems are changed. Make sure that they're coded correctly. I'm going to be very interested in seeing what the final version of the schools amendment looks like, because I think that there's a lot of big money out there that I think there's going to be a lot of pushback and
it does seem quite unfair and hopefully unintended that this big VAT liability could arise. So let's see how it falls.
Yeah, and then just sort of if you are using trusts, it's always important to make sure that you don't fall foul of any of the attribution rules. Just make sure that you've got your structures right. And then I guess the last thought that I want to leave with everybody is prepare for audits and penalties. We are seeing a lot more questions coming from SARS. I'm pretty sure that there are people in the audience who are getting verification request upon verification request. They are, as I mentioned, they are choosing behaviors at the highest level of penalties. So I think it's unfortunate and unfair, but again, document, seek advice on anything. Make sure at the early stages, don't wait in an audit until something becomes an audit to engage an advisor. When you get your first verification letter, you should be already anticipating that that is going to end in an audit, and speak to somebody, get everything in order. I think that if that is my sort of closing sentiment that I want to leave with everybody, I think that's it.
Absolutely. And I think that's supported by the level of sophistication and complexity we're seeing in these changes. You know, there's a lot of people who are very negative about many of the systems in South Africa, but SARS is jacked up. They've got a lot of very smart people in there who understand where the loopholes or potential loopholes can sit, and they're applying their minds to try and close them down. We've seen they're also applying themselves to make it easier for them to audit and hire and levy higher penalties. So yes, underestimate SARS at your peril, I think is a key takeaway.
Cool.
Great. Well, Tracy, thank you so much. I think you've done a really great job of summarizing some very, very complex
Not that easy.
and wide-ranging provisions. And guys, thank you all for sticking with us. I think we might have a question. We do have a couple of minutes left for questions. Otherwise, we will send out we just had a comment. Thank you. Here's a question. What are the suggestions for receiving payments from foreign pensions? So I am going to answer that one. Highly complex. Definitely worth discussing. It depends on where your foreign pension is from, where you were resident and in what period, and what the relevant double taxation agreements say. So no simple answer, but definitely one worth considering. Guys, we will send out the recording and our slides, and Tracy and my contact details are on the slides. Please feel free to be in touch with us with any questions. We will be following the draft legislation as they go through the process, and we will be issuing newsletters when the final version is out. But for now, this is our thinking on the key changes and what people need to be considering. So let me just see, I think we might have one more question. Guys, it's your last chance to ask Tracy any questions. No more. That's it. So Tracy, a final thank you very much. And we will send out the slides shortly. And please let us know if you have any questions or anything you want to discuss. Otherwise, enjoy the rest of your day.
Thank you. Bye, everybody.
Bye.